Hello, welcome back. I hope you're having an awesome weekend. It's been a little while since I made a video, and there is a reason behind that. I was actually recording one of the first face videos that I'm gonna be putting on the channel, and there's going to be a few more upcoming. It's pending editing right now, so it's gonna take a few days, but shortly you will be able to watch it. Now, for this one, I want to be taking a little bit of a look at a company that I would love to own, that is Tesla, but it has always been expensive. Now, recently there has been a little bit of a pullback. You can kind of see it here in the 1 month chart. Like for instance, over here it was almost $300. Right now it's going back down to 260. And so in this video we're going to examine what happened. We're going to examine what happened during the earnings report and try to see what kind of price we could potentially and we should potentially pay for this company if we are willing to purchase it. Now for Tesla here, you will see that the share price dipped actually, and I think it dipped almost 10% that day after hours as earnings call disappoints. And what happened here is that they posted an all-time high quarterly revenue, but operating margins dropped to 9.6%. And the revenue from Tesla's core automotive business rose 46% year over year. And the reason basically for what happened with the stock price going down, you can kind of see it as well. You can see it over here. The stock price remained flat after the initial report, but began dropping during the earnings call as the CEO, Elon Musk, and other executives failed to deliver precise specs and start of delivery dates for the Cybertruck and for a robotaxi-ready vehicle. And as you can understand, this is not really significant in terms of the actual economics of the company, but it's a sentiment thing that brought the company's stock price down for a while. Now, the revenue that the company achieved is actually a bit here, almost 25 billion versus 24.5 about that was expected. And the earnings also a beat, 91 cents per share adjusted versus 82 cents per share adjusted. Now net income was 2.7 billion, an increase of 20% from last year, and operating income fell a little bit from last year at 2.4 billion. So interesting to see here that again the company's financials are not worsening, yet we got a potential here for buying at a better price. But is the price there yet for somebody who wants to buy the company? You will see that since its 1 year high of $315, we're still down. So last year the company was actually significantly higher than what it is right now. And if you take it back to 5 years, for instance, you will see that the company was at a level like near $400 and more actually at some point. And right now, 260 looks like an opportunity. But over here, at least in this channel, we want to be buying things at cheap prices. So this is what we're going to be examining. We don't just want to be jumping in a company if it has fallen off a cliff, for example, or if the price has actually fallen a lot. We also want to be buying it at a good price compared to what they are doing financially. And of course, we do love these companies that go down a lot. Don't get me wrong. Like I bought Meta, for instance, and it skyrocketed after that, so made a lot of money there. But the thing is, we want to be buying companies when it's worthwhile. We want to be buying them when they are cheap as well. That's key actually for at least eliminate, or if not eliminating, actually limiting risk. Now, 67.6 is the P ratio right now, and you will see where it was. Like it's significantly better right now. And the price to free cash flow is still a little high, but again, it used to be like 300 over here, so significantly higher. It's getting better. Now, the company, generally speaking, has been issuing shares, and it makes sense because the stock price has been skyrocketing. It looks like this probably will stabilize, at least hopefully, because right now the company stock price is a little bit down, and even though it's expensive potentially, it's still not as high as it used to be in the past few years. So maybe the company won't be issuing any new shares anytime soon. Now, the total liabilities to free cash flow are fine. Less than 5 is what we want here. So the company generates enough free cash flow, and they don't have a lot of debt as well. Their margins have been climbing, generally speaking. Now they're going to like 13% right now, but they used to be like 15% at some point. We also want to be taking a little bit of a look at the income statements, and again, I'm using our tool here for which all our patrons have access to. And if you are interested in becoming one, there's a link in the description box below this video as usual. And you will see the revenue of the company. It's actually very, very fascinating to look at what the company has been achieving during the last 10 years, from 2 billion to 81. So amazing growth here, absolutely amazing growth for the company. The only thing is entering at a proper price is the important thing here. And the net income of the company has been negative for a long while, but then it started becoming more and more positive, and right now it's sitting at 12.5 billion for their net income. And the balance sheet of the company, you will see that is also getting better, with total equity increasing from 5 billion to almost 45 billion over here. So significant increase. But you need to remember that the company has also been issuing tons of shares, right? You should never forget that. And you can see it here in the additional paid-in capital from 10 billion to 32, pretty much every year issuing more and more shares. And that's not good for stockholders that are already holding the stock because it dilutes them. However, it does increase the equity of the company. So for newcomers, for new stockholders, this is generally speaking a positive sign, as long as the company cuts down on issuing shares. And this is another good thing about buying cheap. When the stock price gets cheaper, the company's board won't be issuing more shares, more than likely. This is the time when they are buying back shares, and this is the absolutely best time to actually buy shares and not sell them. Now, the cash flow statement, you will see as well that for a long time the company has been doing sort of like it's either negative or close to zero, and then started to skyrocket, like from 2.7 billion, 3.4 and 7.5 right now. Very, very nice increase for the company, and it doesn't seem to be ending anytime soon. This is what you'll have to see. I was examining a very interesting article here, which I actually found in our stock news page here, which I always browse for a lot of different companies because it's amazing and like it gives you a lot of nice information here about all the companies and pretty much any company that you decide to take a look at. And Tesla had a very nice article about Warren Buffett and a very nice quote here for which I agree. A clever analogy for what it's like to be a publicly traded company. And I kind of wanted to mention that. Warren Buffett's analogy is that being a publicly traded company is like having someone stand at the edge of your home and just randomly yell different prices for your house every day. It's still the same house. And that's exactly what is happening in the stock market. We're talking about the same company, and it has happened with all these companies like Meta, Google. Everybody actually gets that at some point. Apple, every company really gets that. The trick is to actually evaluate these companies properly and buy them when they are cheap. This is exactly what we want to be doing. And remember, this is exactly what we did with Meta, right? Like if I take it back here, you will see that Meta right now is a company that I probably wouldn't buy today, but I would buy it when it was like 80, and I did buy it when it was like 150, and I made a lot of money actually doing that. Now you will see that right now it's not like super expensive, but it's relatively expensive compared to what it used to be, so it becomes a lesser opportunity. It's still not a lot terrible, but it's also not amazing as it used to be. I do think that, for example, Alibaba is an interesting case, but a lot of people actually are having some doubts about China, which are understandable, but I think they're going to be temporary. Anyway, let's go back to Tesla. And for Tesla, the other thing that we want to examine is how cheap the stocks are, how cheap the share price is. It's sitting at 260 here. And the way to do that, a very reliable way, is to actually evaluate it compared to the discounted cash flow, compared to the cash flow that the company generates. This is extremely important because it actually compares the value of the stock price to the money, the actual money that the company generates, the cash flow. And it's really, really important for evaluating companies. Now, you will see that the revenue growth of the company has been tremendous every year. I'm not going to go that far. I'm not going to go so high like 50, and 50% over here, even though the company is achieving, again, tremendous revenue growth. I'm going to be super conservative, at least much more conservative, not super conservative, like 10%, 12%, and 15%. I think is fair here. The company is already making 81 billion, right? So they're making a ton. And for net income margins, I'm going to go somewhere around 15 and 13%. It looks like it's a little bit less right now, or 12%. So let's go 12, 13, and 15 here. And the free cash flow margins used to be like 60% when the company starts picking up a little bit. So it looks like they are similar to 60%. So I'm going to go 60, 65, and 70 here. And the annual return, 13%. Now, you could potentially be a little bit more confident potentially by increasing the free cash flow margins of the company. This has a lot to do with the capital expenditures of the company and how much they will increase those or reduce them in the future, of course, obviously. But in this case, I want to be trying 60, 65, and 70%. And of course, all our users of the tool can try their own values and evaluate accordingly. Now, with these values here, if I hit calculate, let's see what we're getting. We're getting a 37 actually for a low, and a 48 for the medium, and a 67 for the high. And obviously, again, I have been relatively conservative with low free cash flow margins. And if I go a little bit more normalized margins like 80, 90, and 100%, which I typically tend to use, but of course it's not the same for every company, then we're getting a little bit of a higher value like 50, 66, and 95. Yet we are still very far from the 260 that the company is at right now. And even though the company is a fantastic company, and actually at some point I even wanted to buy a Tesla myself when I was living in the US at least. It's much more expensive actually in Europe to buy a Tesla, but regardless, it's a great car, and I think the company is going to be doing fantastically well. However, I'm not willing to buy it at that price. It would probably have to go down significantly more, and at some point over here it was like $100, and even then it was a little bit more expensive, but obviously much better. Right now at 260, even though it went down a little bit, it's still expensive, and I think I would avoid it quite significantly, quite a lot for now. It would have to go down a lot actually from where it is right now for me to potentially be interested. But do tell me what you think about Tesla. Some people had a great opportunity potentially buying here, even though again still it was a little bit expensive here. It picked up a little bit later. It was expensive, but it was much cheaper than what it is right now, right? That's the important thing. So if you bought here, it did make some sense. It was still expensive, but not as expensive. It was significantly cheaper than today. Thank you for watching, guys.